Let's take a couple minutes and talk about this. Unfortunately, yes, mortgage rates are at the highest level since December of 2000. But what happened and how did we get here? There's really three things that have happened recently that are driving rates up, so let's talk about them. By the way, this is going to be a little bit longer of a video, so just kind of stick with me. Let's start with the US 10-year Treasury that closed over 4.25% for the first time since 2008. Treasury yields rose after a very weak auction, so that just means that investors weren't really buying the bonds at the lower yield, so unfortunately it has to go up. And while the US 10-year Treasury doesn't directly impact mortgage rates tend to follow the trend of that Treasury, so as that goes up, so do mortgage rates. Factor number 2 is China's central bank cut interest rates in a very surprising move due to weaker growth data, and unfortunately, their real estate market isn't doing so hot. That obviously leads to the question, why would China's moves affect anything that we're experiencing over here? Remember in previous breakdowns, we talked about how economic data is going to swing things more because the Federal Reserve is more data dependent. China is the world's second largest economy, so seeing weakness and unexpected data coming out of there is going to give a lot of markets pause and build in a little bit more risk, making everything a little bit more expensive. Speaking of the Fed being data dependent, their meeting minutes are the third reason we saw an increase in mortgage rates here as we wound the week up. The above quote, most participants of the FOMC continue to see a significant upside risk to inflation, which could require further tightening of monetary policy. Which basically means they're not sure that we're done seeing inflation be a problem and they're leaving room for more interest rate hikes. And when you look at some of the less impactful economic data that came out, like retail sales coming in strong and other things, we are still seeing a pretty resilient economy. What do we do? Oh my God. Well, that's a great question. You have two options. One, you cry about it and you sit there and you pay 100% interest on your rent. Or two, you take advantage. I know that sounds weird, but when rates are higher, competition is way lower and there's not as many buyers, which means sellers don't have 40 options to choose from when they list their house. Which means you can get a great deal and maybe negotiate some seller concessions to lower your cost. And although your payment may be higher, you can always refinance. The Federal Reserve still expects to cut rates towards the end of 24, which means in 25 and 26, we should see some decent improvements. And with tools like our rate drop pledge that's good through 2027, you're going to be able to do that at a very low cost without lender fees or paying for an appraisal. So the important thing here is to remember to focus on your affordability. You can't control what's going on in the market. I can't control what's going on in the market. But timing the market is almost impossible. And time in the market has historically always panned out, whether it be equities and stocks or real estate. So if you have questions on affordability, want to get a second look at your mortgage, or just generally what's going on in the market, shoot me a message. Let's have a conversation. And I'll leave you with the words of wisdom from Mr. Warren Buffett. Be fearful when people are greedy, and be greedy when people are fearful. Happy house hunting.